Before taking the stage, let me just introduce myself, Maria Saccomanni. I recently joined the OECD. I have a background that is, I used to work in the private sector as an advisor first and then as a tax manager in a multinational group. So now with step 3, we describe the rule on how the numerator to the ETR fraction should be computed. As a first key concept of the pillar 2, please consider that the numerator is made up of 2 big components. One is the current tax, and the other is the deferred tax amount. And this is because in pillar 2, a specific position is being taken in respect of deferred taxes due to the fact that an effective tax rate that is built only on current tax expense and do not consider the deferred tax amount could give rise to certain distortion because, for example, of the availability of tax losses that reduces the current tax expense, or because there are some relevant timing differences, i.e. differences in the computation of the tax base and differences in the accrual basis principle under the relevant accounting standards. So having an effective tax rate built on deferred tax assets is definitely a good point because it helps us in determining an effective tax rate that is as much as accurate as possible. The starting point for both the current tax and the deferred tax is the financial account, as commented by Scott. We start from the accountings and the accountings to be prepared according to the accounting standards of the ultimate parent entity for the purposes of the consolidated financial statements. Once identified the current tax expense accrued in the tax line and the deferred tax amount, then a specific adjustment shall be done. So now let's focus on the current tax expense and its adjustment, and then we will consider the one of the deferred taxes. First type of adjustment to the current tax expenses is aimed at excluding that taxes accrued in the tax line which are not covered taxes under the definition of pillar 2. So which is the definition of covered taxes. Basically, these are taxes on income or profits, taxes on distributed profits and deemed profit distribution, taxes imposed in lieu of a corporate income tax, taxes on return earnings and corporate equity, and taxes that might be levied on multiple components, both an income or an equity component, but where the income component is the predominant one and where it is not possible to split the two. So as you can see, the definition is quite broader than the general corporate income tax that is under the general accounting principle. What is definitely excluded are all the indirect taxes like VAT, consumption taxes, sale tax, payroll and property taxes, which are taxes that generally are accounted not in the tax line, which is the place dedicated to corporate income tax, but you can find these indirect taxes in typically other administrative expenses. So basically, there is no need to make an adjustment on an average basis. And of course, this is another important point. Any type of tax that is levied under the Pillar 2, that could be the income inclusion rule or the UTPR, that is accounted and will be presumably accounted in the tax line being qualified as an income tax, will be excluded, of course, in the computation of the numerator for the ETR. Otherwise, we have, of course, circularity. So when a corporate income tax, when a tax that is accounted in the tax line do not qualify as a cover tax, that should be excluded from the numerator, and in the majority of cases shall be included in the denominator because it is a deductible expense. So there are some adjustments to be done to the cover taxes. The main reason, apart from restricting the scope to the cover taxes, is to grant symmetry and functional connection with the globe base. So I'll give you an example. If a given item of income is excluded from the globe income or loss, let's consider the dividend, for example. If any tax is levied on that excluded income, on that excluded dividend, also the taxes shall be excluded from the numerator, even if we have, even if it qualifies as cover taxes. And another exclusion that is another goal that is that the rules want to reach is that the cover taxes represent taxes that are actually paid within a 3-year period. And this is why uncertain tax position are not considered, are excluded from the numerator when accrued, but these are considered when actually paid. So let's now consider the second component of the numerator, that is the deferred tax amount. Let me point out one consideration. The financial accounting net income or loss is the one that should be determined according to the accounting principle of the consolidating entity. And it may happen, and it generally happens, that the accounting principles used by the single constituent entity may be different than the ones used for consolidating, for financial consolidated purposes. So for example, a local GAAP might be converted into the IFRS or into the US GAAP for the consolidation process. And such conversion generally triggers some timing differences. And timing differences means deferred tax asset or deferred tax liability. And these should be included in the what is the starting point for the computation of the deferred tax amount of the single constituent entity. Also for the deferred tax asset, the main driver for the adjustment to be done is to grant symmetry with the denominator. Just a quick example. If, according to the GloBE rules, a given item shall be excluded from the GloBE income or loss, and this item, according to the local tax rule, gives rise to a timing differences. I give you an example: the accrued pension fund. Accrued pension fund, according to the GloBE rules, shall be treated as a permanent adjustment because a cash principle should be followed. According to local rules, accrued pension fund rather opens at timing differences. So generally speaking, a deferred tax asset is accrued. Granting symmetry in respect of this type of adjustment means that the deferred tax asset accrued in respect of this expense item shall be excluded as well, so that we eliminate the expense from the denominator and the relevant DTA from the numerator. Another adjustment is referred to the need of granting that deferred tax liability actually reverse within a maximum period of 5 years. So deferred tax liability are a tax expense, a deferred tax expense that increases, of course, the numerator, so increases the effective tax rate. If this deferred tax liability would happen that are not reversed within this time frame, a sort of recapture rule applies that requests that the year in which that deferred tax liability were accrued would need to be recalculated, reopened. This is the general principle. Then we have some exception to the recapture rule. Then we have specific adjustment which are related to the recast, according to which the DTA and DTLs need to be computed under the minimum tax rate rather than the effective nominal rate of the jurisdiction if this one is higher than 15%. And another important aspect is that any valuation allowance or any restatement of the DTA, deferred tax asset, is completely disregarded for Pillar 2 purposes. It means that if a given deferred tax asset would not be recognizable in the accounts because it does not meet the sustainability test, probability test under the accounting principle, such a valuation allowance, or as somebody called it, also impairment of the DTA, is totally disregarded for Pillar 2. So the DTA as determined on a theoretical basis on the DTA shall be considered. Then to complicate again the situation on the deferred tax asset, I just give you some high-level info. There are some transitional rules as for the first year. So the DTA and DTL to be considered as the stock DTA and DTL of the transition year follow special rules that from one hand aims at simplifying life for the multinational group. On the other hand, try to prevent some sort of abusive behavior where, for example, a DTA could be, let me say, artificially created, because a DTA that is good for Pillar 2 purposes means that I have the right to increase taxes in the future, because the reversal of DTA is a deferred tax expense increasing ETR. Okay, once we defined all these adjustments for both current taxes and deferred taxes, also here, and we anticipated a bit already, we need to allocate the adjusted cover taxes to special entities where there are cross-border income and cross-border taxes. The rule basically follows the same principle we have seen for the allocation of income for permanent establishment, for flow-through entity, for a hybrid entity, and for CFC. These are the situations where taxes are paid on a cross-border basis. So as for the PE, we have seen that the taxable income of the PE that is included in the parent in the main entity jurisdiction shall be carved out and allocated to the jurisdiction of the PE. Then there is a particular calculation for at the level of the main entity to determine the amount of taxes that shall be pushed down to the PE. Of course, such a calculation needs to be done where the PE is included on a worldwide taxation basis at the level of the main entity. If it is exempted because of a branch exemption regime, doesn't need to be done. As for the CFC taxes, the principle is the same. We have a CFC push down of the taxes paid at the level of the parent. And without entering into very much detail, there is a rule. There is a rule that says that such push down shall be limited to the amount of taxes that are actually levied by the parent on the passive income of the CFC. So that if, for example, a jurisdiction imposed a CFC tax on the overall income of the CFC, both passive and active income, it is expected that under this algorithm provided by the rule, the taxes attributable to the active income be not pushed down, but still remain at the level of the main entity and its jurisdiction. As for the flow-through entity, also here the rule mirrors the allocation of the income to the constituent entity owner. The only point here is to verify whether the partnership has any permanent establishment in the jurisdiction or other jurisdiction. So here the rule would say first allocate to the permanent establishment and then the remaining taxes to be moved to the constituent entity's owner jurisdiction. As for the hybrid entity, let me first introduce the concept of a hybrid entity. The hybrid entity basically works like a permanent establishment. It is an entity that is opaque in the jurisdiction where it is localized, and it is seen as a transparent by the parent. So the income of the permanent establishment is taxed both in the in its jurisdiction of localization at the level of the parent. And so here the taxes that are paid at the level of the parent shall be, which refer to the hybrid entity, shall be allocated to the hybrid entity. But here the specific limitation as well applies, also the limitation in respect of the passive income that we have seen for the CFC. Last bullet of this slide is in respect of taxes on dividend distribution. The withholding taxes on dividends do qualify as cover taxes. And here the point is which is the jurisdiction to which these dividend taxes, withholding taxes shall be allocated. The jurisdiction where the distributing entity is, or the jurisdiction to which the distributed income is earned. So the position taken by Pillar 2 rules is a reasonable one, according to which we shall consider the jurisdiction of the distributed entity. It would have been more correct to consider the jurisdiction where there is the entity that substantially earned the income, but it would have meant that complicated system of tracking and traces that the intragroup dividends would have been put in place. So this is the position finally taken for Pillar 2 reason. Okay, so we move to this slide where it is represented the general structure we have seen, just to mirror how the rule work here. So SICO1 is a flow-through entity, so it is seen transparent by BICO1. Accordingly, any taxes that should be paid locally shall be allocated to BICO1. SICO1 does not have any permanent establishment, so all of the taxes flow to the parent. Here we have a withholding tax on intragroup dividends due to the dividend paid by SICO3 to BICO2. And here we see that the withholding tax shall be considered in jurisdiction C. Then here we see represented the rule that we just explained, according to which any taxes paid by the permanent establishment, by the parent on the permanent establishment income shall be attributed here, following of course the special rules provided in the model rules. And here, where the income of BICO2 would qualify as passive income and so be subject to the CFC rules as determined by country A, then such CFC tax shall be pushed down to BICO. Okay, and now we have question number 5, this poll question. Who's reading?
Okay, yeah, that will be me. So for question number 5, we have the following facts. ACO is a constituent entity of the M&E group in country A. ACO wholly owns BICO, which is located in country B. Country B imposes a 5% corporate income tax rate. And in year 1, BICO has a globe income income of 100 euros and a tax of 5 euros. BICO distribute a dividend of 200 euros out of the undistributed profits from previous year, which is subject to a withholding tax of 10%. And if we can launch the question, the poll, the question is, what is the adjusted covered tax of BICO? Okay. Given we are running a little bit late on time, maybe we can close, and Maria, maybe we can start.
Yes, let me close the poll and get into the explanation of the correct answer. So basically, we said that the withholding tax on dividends shall be allocated to the jurisdiction where is resident, where it is located the entity performing the dividend distribution. So in this example, the entity distributing dividend is Invico, and so the 10% out of 220 shall be allocated to jurisdiction B, which added to the 5 of taxes imposed on that country makes the total covered taxes allocable to jurisdiction B equal to 25. So the correct answer here is B. I don't see if there are questions on that. Maybe not. Okay, so I think we can move to the full question number 6.
Okay. Oh, the fact number 6 is ACO is located in country A, which imposes a 20% corporate income tax rate. In year 1, ACO purchases an asset for 100 that benefits immediate expensing under the tax rules of country A, but that must be amortized over 5 years for accounting purpose. You're creating a timing difference. And then the globe income for year 1 is 200 minus 20 of depreciation, which is 180. The taxable income is 120 of tax is paid in respect of year 1. So now we need to do a little bit of math. So the question is, we can launch the next polling question. What is the ETR for ACO in year 1?
Okay, maybe I don't stop the poll and start explaining the answer. Okay, so as described earlier, the adjusted covered taxes is made up of 2 components. We have the current tax expense, and that in this example is 20, and we also have to consider the deferred tax amount. So the tax calculation in this case represent a deferred tax amount in respect of a tangible asset. This tangible asset has a different treatment from tax purposes and accounting purposes. The accounting purposes consider an amortization in 5 years. So in the tested year, we have a depreciation amount of 20. So that makes the carrying value of that asset equal to 80, which is 100 minus 20. While the tax basis of the asset in this specific year is already 0, because it has been totally deducted. It's a sort of accelerated depreciation. So which is the timing differences here is 80, because we have the accounting carrying value 80 and the tax basis that is 0. And on such a delta, we have to build the deferred tax amount. According to the accounting principle, probably it would be determined under the nominal tax rate, but according to the Pillar 2 rules, it shall be determined at the minimum rate, that is 15%. So the deferred tax amount is equal to 80 times 15%. So the numerator is equal to 20 plus 8 times 15% divided by 180. That makes the effective tax rate 17.78%, and so higher than the minimum rate, and so no top-up tax percentage is determined. So right answer here is letter D. Thank you all. We appreciated your participation. I hope you find it useful and interesting.